Good evening and Happy New Year to all the participants. History has shown disruption can create huge equity opportunities to make wealth. For example, emerging technology, which transforms industry and radically impacts society, has created enormous wealth building opportunities. For example, in 2000s, smartphone was introduced and it totally disrupted the existing technologies. And Tesla is fresh in our minds as it went up from 90 USD to 900 USD in less than 15 months. It is still fresh in our minds. We need a fund manager who has experience and competence to envisage the disruptive trends in the environment and to take full advantage of those opportunities for wealth creation. Today, we have one of the brightest and the most experienced fund manager with about 31 years of equity market experience, handling over 1 billion USD as a year. PMS Bazaar is delighted to welcome Mr. Hiren Ved, co-founder, director, CEO, and CIO of Alchemy Capital Management. He is going to speak on investing in a disruptive world. He will present the opportunities that have arisen as a result of disruptions in the investing landscape, such as technological advancements, macroeconomic condition. Even pandemic has thrown a lot of opportunities in a chaotic situation. Mr. Hiren Ved will present the strategy for about 30-35 minutes. After that, we will take Q&A. Kindly avoid stock-specific questions, and the stage is yours, Mr. Hiren.
Thanks, Mr. Sivaram, and thanks to PMS Bazaar to give me this opportunity to present my views. And I also welcome all the participants for their time. And I hope that the next 1 hour will be productive and a learning experience. As Mr. Sivaram mentioned, the topic for today that I want to speak about, which is very close to my heart, is investing in a disruptive world. We all know that change is a constant, right? There is continuously change that is happening around us, and whether it is geopolitics, whether it is technology, whether it is regulation, and all of this in one way or the other impacts businesses, and in turn it impacts the investment landscape. And we are presented with both a lot of challenges as well as opportunities when this change is underway. And believe you me that while we've seen tremendous change across many years in the past, in my 31 years of investing experience, I think what we are currently going through is a massive churn and disruption which is hitting every industry. And therefore, I think it is extremely important that not just the businesses learn how to adapt and take advantage of the change, but even as investors, we need to recognize this change and we need to adapt our portfolios and investment strategy in sync with what we are seeing in the external environment. And as Charles Darwin mentioned, that it is not the strongest of species that survive, nor the most intelligent, but the one that is most responsive to change. We all know Elon Musk of Tesla, right? He is one of the big disruptors in the global automotive industry, and now he's disrupting many other industries like energy. He's also taking a leap into space. And he said, I can either watch it happen or I'll be part of it. Clayton Christensen, which is a management guru, mentioned that if you defer investing your time and energy until you see that you need to, chances are that you will already be late. And True disruptions means threatening your existing product, your past investments. Breakthrough products disrupt current lines of businesses, right? And it's very difficult, but I think companies which attempt to do that are the ones that really succeed. So let's look at what is driving this change, right? And I think that if you look at the current landscape, right, I think there is a plethora of change at a regulatory and policy level, which is driving businesses to change in a certain manner. And this change, I believe, is permanent, right? So we have obviously talked about a lot of regulatory changes in India over the last few years with respect to GST. We've seen very large sectors of the economy like real estate also going through a massive change and consolidation with the implementation of RERA, which is the Real Estate Regulation Act. And, just to give you an example, that so intense has been the impact of RERA that it has actually wiped out almost 70-80% of the developers that were there pre-RERA, right? And very few developers today are surviving in the post-RERA regime. Similarly, the bankruptcy code, created opportunities for existing companies to buy out weak, assets, promoters and founders who could not pay back to the banks in pre-IBC were able to keep their companies for years together, fighting with the banks in the courts. But today, these assets are now moved into stronger hands, just like Tata Steel bought Bhushan Steel. The SRs lost control of SR Steel, and that went to the Mittals. And we've seen a dramatic change. Competition has always been there. Safety and environment, very, very important, right? I think it was okay for businesses to carry on polluting the environment and the rivers and the groundwater, but that's not going to be sustainable anymore going forward, right? Things like data localization, right, which is forcing technology companies, including the large technology giants. Countries have realized that the data of its citizen is a very valuable asset, right? And you cannot have our data not residing with us, because the future of the world is data analytics, right? Today, businesses have been built on data. And just imagine if we are going to export all that data out of the country, then we will also start losing control of many of our industries, and that is a big significant change. And then COVID, right? I mean, COVID restrictions changed many things. I think it was one of the big triggers for accelerating, to some extent, deglobalization, if I may speak, right? Essentially, the fact that suddenly during COVID, you realize that borders can be shut, movement of people and goods can be severely restricted, which means that supply chains have gotten disrupted. And suddenly, countries and companies have realized that they need to have domestic manufacturing capabilities, because you cannot be subservient to just one source of supply, because your own production could be restricted. And not just production, just think about it, right? And when I talk about this, people really understand the gravity of the situation. Now, just imagine if we as India did not have the capability to manufacture our own vaccine. And then just imagine that you had to vaccinate 1.3 billion people using imported vaccines. I mean, this country would have taken a long, long time to come back on its feet. And because, every country, the few countries which had the capacity to manufacture the vaccines would have first prioritized giving the vaccines to their own population rather than exporting it to a country like India. And what would we have done? Waited in the line for 2 years or 12 months, 18 months before we could import the vaccine. And then the cost of vaccinating 1.3 billion people would have been just completely enormous, right? So I think that, COVID has really opened up the eyes of governments, regulators, and companies that extreme globalization is also not good. Just in time, keeping no inventory, having just one supplier for a product can be very terminally difficult for a business. So I think all of this is kind of changing the landscape very, very dramatically. But in my view, the most important reason why there is disruption happening and the change is accelerating is because of technology, right? And I think that technology today is driving and changing and disrupting every industry. So, whether it is green energy, whether it is blockchain, whether it is social media, social commerce, once we get 5G rolled out, you will see that there are a host of new services which can be delivered, which means that companies have to be ready to be able to deliver those services to their customers, else they will risk losing a competitive advantage. And I don't know if some of you read today that Reliance is already tied up with a Finnish university to do research on 6G technology, right? So technology is changing very, very rapidly. If you look at healthcare, biotechnology and gene therapy will change the way medicines are made or healthcare is delivered, right? And then we have the metaverse, which was in the news today. Already, some of the biggest fashion brands, apparel brands, globally are already setting up their virtual malls, right? So you could actually don't have to go to a physical mall. You can actually, through VR, AR technology, visit a mall, which is virtual, and you could try on clothes without actually trying them on, and that's going to completely change the way the retail industry works. Electric vehicles, we spoke about that, right? That how EV is changing the completely automotive landscape, and I'll talk about that in a few slides going forward. And then the last one, which is more relevant in the Indian context and why we believe that we are at an inflection point in India, is the India digital stack, right? Now, what the India digital stack means is that we started this very ambitious program of Aadhaar, which is a biometric identification of each individual, right? So earlier, if you had to prove who you are, you needed a ration card or your passport or your voter identity card. Now the most important thing is your Aadhaar card, and that is your contains your fingerprint, it contains your biometric information, and that's your digital identity, both in the physical world and in the digital world. And what it means is that today you can do an eKYC. You don't need to be present. The banking industry and the financial services industry is already moving towards that you can do a video KYC and you can open a bank account in minutes, right? You don't need to necessarily go to the branch. And then on top of that, what this government did when they came to power, which was they took Aadhaar to the next level by saying, let's now link the Aadhaar to the bank account through your mobile phone, right? So you can then connect all the essential services with your identity. And then we had a revolutionary payment system that we created, which is through UPI. And UPI is very, very unique today. Many of the countries like the US doesn't even have a UPI system. I mean, if you go to the US, the banking system still looks very archaic, right? Today, you can zip payments up and down within minutes. So I think what this has created is what I call as a digital highway. What India has created to the India stack is a digital highway where the velocity of transactions can move very, very quickly. And it is as simple, but it's a very, very powerful concept. And we are already seeing the power of that today with the kind of velocity of transactions that we are seeing on UPI. It's just completely phenomenal, right? So I think that the basic architecture which is required to accelerate disruption and transformation is now in place in India, right? So what is going to happen? I think that what happens is that disruption causes massive value transfer, but it is also shortening your business cycles, right? The time it took for companies to reach a certain market cap is shortening. So for example, Starbucks took 30 years to reach a $10 billion market cap, and Apple took 20 years, but Uber did it in less than 5 years, and an Amazon did it in less than 5 years, right? So business cycles are getting very, very short, and humongous market caps are being created in a very short period of time. And that means that you as an investor have an opportunity to position yourself early in the game and in the right kind of companies which are creating those disruptions and creating massive value over a long period of time, right? In a much shorter period of time. Again, we've just used the example of the Nifty constituents, right? So if you look at the original Nifty 50 stocks in 2002, you will see that only 20 stocks have survived from amongst the original companies, and 30 companies are no longer part of the Nifty, right? And that, in my opinion, from here onwards, will even change more rapidly than you've seen. So suddenly you have companies listing at large market caps, which are already, maybe in the next 2-3 years will start getting into the Nifty. And if you look at the Dow Jones, which has a 125-year history, probably General Electric was the longest living stock which could survive in the Dow Jones right from 1907 before it was thrown out in 2018. And similarly, Procter and Gamble, right? So it's going to be harder and harder for companies to stay relevant as we move along. And that happens because of two things. One is that either there is a downfall in those companies because they fail to adapt. So we all know the story of Kodak, what happened, right? I mean, virtually a very large blue chip company has virtually gone into oblivion because they were not able to adapt from photo films to the digital camera age, right? And that, to my mind, is very, very instructive. Let's take some global examples, right? Tesla. And it's quite interesting that if you look at the end of 2014, the traditional OEMs, right? Your Toyotas, the Hondas, the GMs, the Fords, the Volkswagen, all of those put together were $800 billion in market cap. And Tesla was about 28 billion. And today, just in about 6 years, in about 6 to 8 years, we now have Tesla's market cap has gone from 28 to almost 900 billion, right? And the rest of the industry is just barely at 1.2 trillion. And if you look at some of the other new age players like, the new companies, they have, even without selling a single vehicle, is now have a market cap of 211 billion. So suddenly what happens when a disruption happens is that you get a new player who comes in and changes the rules of the game, right? And has tremendous wealth creation that happens. And unless the existing guys start to adapt to the new scenario, they are likely to get derated by the markets. And that's the collective wisdom of the market that you see at play again and again and again, right? If I give you an example in the Indian context, and I have one or two slides on India, but since we are talking here, just think about it. A couple of years ago, Patanjali created a massive flutter in the FMCG industry, right? Baba Ramdev came from nowhere and suddenly became an FMCG behemoth. And what was the disruption? Well, he came on the platform of Ayurveda, natural ingredients, right? And suddenly it sent all the existing FMCG companies scampering. And today, I mean, obviously, a lot of the existing companies had to come up with their own versions of Ayurvedic toothpaste. I mean, suddenly, Patanjali took a large market share in honey, in toothpaste, in a lot of the FMCG categories, right? And built in a very short period of time, has built a 10-12,000 crore empire. And now with the acquisition of Ruchi Soya, they're actually even going IPO. So you can imagine the kind of disruption that a new player can bring in. And if you remember, during the time that they came in, actually the market caps of Lever and Colgate, everything actually fell. And those stocks didn't do anything for a long period of time because people felt that here is a guy who's going to come and disrupt the industry. Well, the good thing is that many of these guys adapted. For example, Hindustan Lever went and bought Indulekha. They all made a couple of acquisitions in the Ayurvedic space, and a lot of the Ayurvedic companies got picked up. Smaller brands got picked up by the large FMCG companies. So that's the power of disruption that you see going forward. Now, if you come to the entertainment and the media industry, right? Suddenly you had great media companies like Walt Disney, Discovery, and then comes Netflix, which completely comes and disrupts the way entertainment industry works. And if you look at the kind of market cap that Netflix has built, you will see the kind of enormous market cap that some of these companies have been able to build. And many companies actually lost market cap, right? And now you are seeing a flurry of mergers and acquisitions that are happening. For example, Star and Disney got together and had to do a merger so that they can then start competing. And look at what has happened. Every broadcaster and media company worth its salt had to come up with their own OTT software, because you had the guys like Amazon Prime and Netflix coming in and barging into an industry where they had no, Netflix was a DVD retailer, right? And from there, it has become a media behemoth. And they have quickly taken subscribers. If you look at the subscriber growth, it has grown at a staggering compounding 25-30% subscriber growth for Netflix over the last couple of years. And as Bob Iger, who was the erstwhile CEO of Disney, said, it is one thing to be as fortunate to have Disney, ABC, ESPN. These are all brands that Disney owns. Pixar, Marvel, Star Wars, and Lucasfilms. But in today's world, it is almost not enough to have all that stuff unless you have access to the customer. And Netflix taught that you could all you needed was an app on your phone or your tablet. You did not have to necessarily go through the traditional cable TV dish route. You can directly stream content onto your smart TV and start consuming content at the time that you want it, right? And we are seeing that beginning to happen, the kind of disruption that has happened in the media industry. Closer home, I think people will now see, and this has just about happened in the last 18 months, right? So it is very fresh. Now, we all know that banks like HDFC and Kotak are phenomenally well-run banks. They are great franchises, right? They have a long track record of delivering value to customers and to investors. But what is happening now is that technology is playing a very, very important differentiating role when it comes to financial services. And the market has started to take notice, right? So if you look at the kind of returns over 2 years and 3 years, if you look at the chart on the right hand side, right, the bank index has probably given, it's first of all, the bank index has underperformed the Nifty, and that's a very different reason during COVID. But the bank index has delivered a 5 and 9% CAGR returns, and this is largely from Jan 2020 pre-pandemic to, let's say, December 2021. So we've taken 2 calendar years, and for 3 years we've taken it from 19 right up to 21, right? If you look at it, you can see that HDFC Bank and Kotak have underperformed and while Bajaj and ICICI Bank have massively outperformed. So what is it that is happening? Is it that, obviously they are all great franchises. Bajaj has been a great franchise. ICICI Bank has transformed itself. But in my view, as an investor and as a fund manager, my view is that the market is already starting to vote. And the market is saying that, look, you may be a great franchise, but the next 5-10 years, if you want to grow, you need to have your digital strategy in place. You need to be at the cutting edge of having the capability to have your customer journey seamless, right? Because today, again, very few of us go to a branch. Everything is being done on your mobile phone or through your PC, right? Whether you want to start a bank account, whether you want to put an FD, whether you want to buy insurance, whether you want to buy a mutual fund, whether you want to take a loan, a lot of things are now seamlessly moving online. And I think the market is beginning to tell you that we are going to reward companies that we perceive are way ahead in their digital journeys as compared to people who are still catching up. Now, that doesn't mean that a HDFC Bank and a Kotak Bank can't do that. But the fact of the matter is that as things stand today, right, the market's very clearly voted that we need, these companies need to have deep capabilities, because what is happening is that the entire value chain earlier was with the bank. Now with the fintechs coming in, they are starting to compete at small parts of the value chain, and they are disrupting the banking system, right? And if you remember, just a few weeks ago, Uday Kotak tweeted, and he said that the banks are way behind in the payment ecosystem because they thought payments mein paisa hi nahi hai, there is no money in payments, so why go after it, right? And then suddenly you had companies like Paytm, though they don't make money, but they were able to have almost 35 to 36 million customers onto their platform, using them for payments, right? Now, today, they don't make money on payments because there is no MDR on UPI. But let's say tomorrow, if RBI decides, and they've just floated a white paper a month ago, that they said that, now that the UPI payments are exploding, there needs to be a balance between consumers and people who provide that services. So if suddenly there is an MDR that is allowed, a small fee that is allowed by RBI, for somebody who's providing a payment service, suddenly, you will have a large revenue stream that will flow to companies which are very, very large in the payment space. And now suddenly the banks are waking up and are starting to get into the game. So if you see recently, Cholamandalam bought a payments company, right? They acquired a payments company. And therefore, I think that suddenly now people are realizing that, a lot of the customers and transactions are going onto a service like payments. And it's like, it's no different, right? I mean, a couple of years back, let me give you an analogy, right? So if Big Bazaar was advertising that I'm going to sell sugar at 5 rupees, when let's say the market price was 10 rupees for a bag, right? Now, why were they doing that? they were willing to lose money on sugar, but that was a hook to get the customer into the store. And once he came to the store to buy sugar, which is something that they need almost every day, and buy it at a discount, the idea was that out of every 100 customers that walk into the store, maybe a small percentage of them will walk out with not just sugar, but buying other stuff on which they made money, right? So I think that what the new age companies are doing is that they create a hook by way of a service or a product, which may be a loss leader today. But if they can develop a business which can cross-sell other products to you and make money on that, that's how they will end up making money. So the point I'm trying to do is that that's why you see Bajaj, even though they were ahead in their journey, finance, they are now talking about Bajaj 2.0, where they're coming up with their payments app, they have their marketplace, they have the insurance marketplace, they have the investment marketplace, right? And the idea is to have omni-channel capabilities, whether for your merchants, whether for the individual customers. And that is what is going to give you the competitive edge to remain a leader of tomorrow. Else, what will happen is that we as investors won't realize it, but there will be a slow and steady derating of existing companies who are not able to adapt quickly to the new environment. Let's look at what's happening in the EV industry in India. We talked about Tesla, but let's look at what's happening in India, right? Now, you see that the so-called also ran or almost a struggler in the passenger car business, Tata Motors, right, is now today almost becoming a leader in the electric vehicle four-wheeler industry, right? And though the numbers are small today, but they are picking up very, very fast. And today, Tata Motors has a 75% market share in the electric vehicle business. And, you know, month on month, they are only increasing their lead when it comes to electric vehicles. And if you look at Maruti, right, clearly, I think that they were behind in the game when it came to electric vehicles. Their first EV vehicle they have now mentioned publicly is only going to hit in FY25. So the idea is that even though Maruti, which has the largest market share, 40% plus market share of the Indian passenger vehicle market, if you see, has given no returns, while Tata Motors, right, has greatly outperformed. You look at what recently happened just a few days ago, right? Hero Motors was doing nothing as a stock. And then suddenly, I think 3 days ago, they announced that they are making an investment in Ather. And since then, the stock has started to move up. The same thing with Bajaj Auto. Bajaj Auto just came up with the results and they announced that they are setting up a 500,000 EV scooter capacity in and they're going to make investments. So I think the markets are telling you that you need to be positioned in the future. So if you ask yourself, what is the future of two-wheelers? It's clearly electric vehicles. And I've not even mentioned one name, right? You suddenly, as I mentioned, when there is disruption, you always have one or two new guys who come in who had no past history of being in the industry, like Ola. Suddenly, Ola has come from nowhere and is taken large volumes in the electric vehicle two-wheeler market, right? And therefore, we need to be extremely careful about what we have in our current portfolios and then analyze these companies, not just on traditional fundamental metrics. Now, it's all important: profitability, cash flow, margins, all of that is important. But what is important is that where is the company in the journey when it comes to what the future of that industry is? So if you're not very well positioned in the future, then I think the market's going to derate you. And the market's willing to re-rate companies that are adapting very, very quickly. So how do you play this disruption, right? Do you back the early birds? Do you back the early adopters? Do you play disruption enablers, right? It is what I call as the picks and shovels approach in investing, right? So suddenly, there is this great thing that when diamonds were found, the companies that made most money were the people who make the shovels for mining the diamonds than the diamond company itself, right? So if you think very smartly, and I'll talk about great ways to play that, is that you need not necessarily, sometimes it's very difficult that you may find it extremely difficult to buy a disruptor because the disruptor may be a loss-making company, right? And you may not be able to take a judgment call on whether I should be investing in that business or not. But you can certainly judge if a business is adapting very quickly to the new situation, and you can be rest assured that value will be protected and value will grow over a period of time. Or a very short way to do that is to play the disruption enablers, the people who are actually helping other companies to be able to compete in the disruption. And that's one reason why the IT services companies has been one of the best performing sector post-pandemic. Why? Because they are the biggest disruption enablers, right? I mentioned, data is moving to the cloud. You need cyber security. People are building web stores. They are reaching out to their customers. They are having their presence on social media. And therefore, spending on digital technology is only accelerating. And the Indian IT services are back with a massive tailwind behind them, because every single company, whether you are in the FMCG industry, whether you are a retailer, whether you are an insurance company, whether you are a bank, right, whether you are a manufacturing company, everybody has no choice but to invest in technology. So if you look at it, if you look at Titan, right? Titan, as you all know, is a great company. They are one of the leaders in branded jewelry in India. And, they created a massive competitive advantage. What Titan is very good at is that they identify a large consumer segment where there is a lot of unorganized market, and where there are small regional players, and then they create iconic brands and a retail format which enables them to scale. And they did it in watches, then they did it in jewelry, then they did it in eyewear. Now they're doing it in saris, right? So category after category, they kind of came, and they are the big beneficiaries of GST. As you can see that this entire industry is getting more organized, and the smaller players are losing share and the bigger players are gaining share. But that's not the point. The point today I want to make is that I think Titan is a great company because they were able to identify the opportunity in online jewelry retailing. And very early, they made an investment in a company called CaratLane. CaratLane is an online jeweler, and it is growing very fast. As you can see, CaratLane's revenue has grown from 100 crores to almost 700-800 crores. And this year, probably they will, this is just for 9 months. So, this year they'll probably cross 1,200 or 1,400 crores. And they have publicly said that in the next 4 to 5 years, they plan to become $1 billion plus in revenues, right? So suddenly, Titan has probably created a mini Titan within itself by positioning itself early in the game of getting into online jewelry sales, right? If you look at some of the adopters, right? We mentioned about what's happening to the media industry. If you look at the music industry, now, well, the overall music industry may not have grown, but I think what has grown is that, as we all know, that, cassettes and CDs and tapes have, the physical music distribution has gone down. And what has really gone through the roof is digital streaming of music, right? And today, a great way to play the explosion in digital music distribution. So now you today listen to music through YouTube Music or through Ghana or through Hangama or one of many of these apps which stream music. But the content provider makes a lot of money because they get a royalty every time you stream a song, right? Every time you listen to a song, you get it. Not only that, in fact, today the youngsters and the millennials are creating short videos, right? And if you are using a song while making a TikTok video, right? If you're playing a song from Sholay, the guy who owns the rights to the song in Sholay will actually get a small part of the royalty today, right? So that's a great way to play disruption that is happening in an industry by somebody who has adapted to this. And Saregama did it phenomenally well. They in fact even innovated with putting that into a box called Karma. But more importantly, now every time you stream any of the content, and they have huge content going back many decades. You stream content, or there is a remake of a song, they get a royalty, for that. If you come to the beauty and personal care market, right? I mean, you look at the kind of explosion that is happening in the online beauty space, right? The penetration is now moving from 2% to 8%. The CAGRs are mouth-watering. And if you look at the overall BPC market, you will see that India's penetration at 6 to 8% is still way below. If you look at China and US, you already see penetration rates reaching in the 20s and the 30s. And I think the same thing is going to happen in India. So who's going to win, right? I mean, and suddenly you sit back and watch that, Hindustan Lever has been selling Lakme for years together, has been in the beauty care market for a long period of time. But here comes a Nykaa, it's created an online platform. They have great presence on social media where they influence young consumers, they help young consumers, and then they have a phenomenal platform where even, let's say, in a small town in Assam or any state, today you can ship a product there, right? Because you've been able to create that, as I said, the digital infrastructure and the logistics infrastructure is now in play. And the same thing is happening in fashion as well, that the adoption of online is just zooming, when it comes to, who thought that, people thought that, buying apparel means you would want to go to the store, try it out. And this is just when I'm talking about online. I'm not even, I shudder to think once you get into the metaverse and you are able to start to, already I think Lenskart has started that, right? So you can actually try out a frame, with your face in a digital format, and you can see how it looks like. You don't have to necessarily go to the store. And all that happened during the COVID time, right? And that's how COVID changed consumer behavior, that everything today comes to you rather than you going to the store. And that means a huge amount of disruption for businesses, because if you can't reach to the customer, then you're gone. You lost the customer because somebody else is reaching the customer at his doorstep or sitting in their homes, right? Now, for example, the one of the companies that we played, and since we've spoken about the disruption in the automotive industry and the media industry, right? We found a Tata Elxsi in India, and this is just an example. So I must make a disclaimer here that, I've talked about a lot of individual companies here. This is not a recommendation. I'm just using these names by way of making a point to all of you. But having said that, if you look at Tata Elxsi, right? I mean, if you look at what is happening to R&D budgets, right? If you see $20 billion of R&D budget is going to shoot up to $61 billion of R&D budget, and whether it is Toyota, Ford, GM, Volkswagen. Why is it happening? Because Tesla and the whole electric vehicle revolution forced existing players to get to an all-electric platform. And today, as you already know, that in Europe, beyond 2030, you can't sell an ICE engine. You can't sell a petrol diesel engine car. It will have to be, by regulation, it will have to be all electric. And therefore, all these companies are accelerating their R&D spending to come up with their new models, which will be all electric. And today, almost 50% of the value of a car is software, and it is not just hardware, right? So, and therefore, there is a great way to play this disruption, right? So there are examples on the right. For example, I did mention Tata Elxsi. You have companies like L&T Technology Services, KPIT. Again, this is just a few companies. There may be many, but this is just to illustrate a point. And as I mentioned, the NSE IT index has done phenomenally well. But if you look at some of these companies, the kind of returns that they have delivered, right, tells you that they are massive beneficiaries of the disruption that is in front of us. So Tata Elxsi, for example, develops software for the automotive industry. They also do it for the media industry. As I mentioned, what Netflix has done. So Tata Elxsi develops a lot of the OTT software for many of the traditional broadcasting companies. They work with global broadcasters. They work with Indian broadcasters. And you know that is how the industry is going. And therefore, there is going to be massive technology spending. And one way to play that theme is to invest in companies which are actually beneficiaries. So, as I mentioned earlier, I think a strong foundation has been laid. The time is absolutely ripe for disruption. I talked about Aadhaar, UPI, GST. Also the fact that today we have a solid penetration of smartphones, right? 54% of almost now everybody owns a mobile phone, but more than half of them are smartphones. And I think once the JioPhone is launched, I think in a couple of years, maybe in a year or 2 years, it's not inconceivable to think that there will be at least 700 or 800 million people who will access to a smartphone. And once you have a smartphone, which means that you can access a lot of these services online. And the third pivot is that while smartphones and broadband is now so easily available and cheaply available thanks to Jio, is the whole startup ecosystem that has developed in India, right? As you know, last year itself, $40 billion went into funding startups. And it is very important, when you want to create an ecosystem of entrepreneurship and disruption, and why this is going to accelerate is because today money is available to the disruptors, right? And because money is available, the entrepreneurial talent is there, and the technology framework is already put in place. That means that this disruption is only going to accelerate. Because if the companies didn't get the funding, right, how would new disruptors come in? And that's why in so many industries, you just had the traditional guys who were always getting into a new industry, right? So when telecom opened up, it was the existing business groups who got into telecom. Yes, there were some new ones who got in, right? But now in every industry, right, you are getting new entrepreneurs and new companies coming in because they have access to risk capital. And that means that you will see acceleration of disruption happening going into the future. And many unicorns have been created. Wealth is being created at a tremendous pace. And I believe that is likely to increase the opportunity set for investors. And it is spawning a whole new ecosystem, right? So traditionally, when people used to ask me, okay, there were some 7 or 8 or 10 sectors in India. So, there are the banks, then there are the FMCG companies, then there are autos, then there is cement, then there is capital goods. But now, in the next 5 years, I think there will be several subsectors and new sectors that will become very relevant, right? So platform companies, e-commerce companies, ed tech companies, mobility, food tech, SaaS, gaming, logistics, fintechs, neobanks, insurtech, right? I mean, payments. I think you are going to see a massive explosion across sectors as this disruption plays out. So the reason we are saying this, so what we did as Alchemy was that we saw this trend pretty early, and 2018 we launched a strategy called Alchemy Leaders of Tomorrow. And we named it specifically Leaders of Tomorrow because, as I mentioned, that because of the change and the disruption that we are seeing, there will be change of leadership. As I mentioned, that out of the 50 Nifty companies, there are only 20 that have survived, right? And a lot that have gone out. So Yes Bank is out of Nifty and Bajaj Finance is in, right? A lot of the new companies are starting to come in. Fresh blood is coming in. These companies are becoming bigger. They are creating wealth at the faster pace. And therefore, as investors, we need to realize and understand what is happening in the environment. And you have to change also your portfolios, not necessarily only with the leaders of yesterday. And I'm not saying that many of these leaders will not be able to adapt. Many will be able to make that change crossover. But you have to be very careful that are they adopting at a speed and with the required agility. Otherwise, new players will come and disrupt you at a very, very rapid pace, right? And that's when we launched Alchemy Leaders of Tomorrow. The strategy did phenomenally well. And now we are launching the second series of that as we speak, because we wanted to bring to investors the opportunity to invest in 15 to 20 companies, which we believe are going to be leaders of tomorrow and may not necessarily be the leaders of yesteryears. So again, it's a multi-cap sector agnostic strategy, 15 to 20 stocks. And our endeavor is to focus on companies which are showing the best traits of adaptability in this new economic normal, which is being driven by innovation, disruption, and ingenuity. I'll probably stop here, and I would be happy to jump into the Q&A. And thank you all for patient listening.
The presentation went like a knife into a cake, sir, and it was how 1 hour went. It went like a whistle. I'll take some questions which has come. And one, Neha Doshi wants to know, technology and fintech can pose a challenge to traditional banks as there were diverse opinion. Only deposit taking franchises can survive in India. What is your opinion on this?
So, yes, you're absolutely right that it's not that the fintechs are suddenly going to become banks tomorrow, right? But as I mentioned earlier, you are likely to see that some part of a bank's value chain will be disrupted by the fintechs, right? Do you know the most profitable part of a bank's lending or ROE is credit cards and unsecured personal lending? These are the most profitable segments for a bank. Now, BNPL is likely to disrupt that. Yes, the ticket sizes are going to be small, but that's how it all starts. It always starts somewhere. You create a small crack in an existing business, and then slowly that crack widens, right? So I think that it's not as if, so there are, I think, a couple of things that will happen, right? I think that banks and fintechs can collaborate. So if banks want to maintain their competitive edge, if they believe that they cannot do it by themselves, for example, a Bajaj Finance has said that I can do it myself. So they are developing their own platform. They are creating their own ecosystem where they can do all of this, what a fintech is doing at an industrial scale. But some bank may wake up and say, hey, look, I can't do this myself. There are other smarter people who can do it. Let me tie up with them. But then you will have to share some part of the spoils with the fintech, right? But that's fine. So I think that, yes, there is the hand of the regulator on the banks that, you cannot take deposits because you are a systemically important organization, and I agree that it's not that tomorrow suddenly Paytm will become a bank. It's not going to happen, right? But as Uday Kotak himself said, that the banks were sleeping at the wheel. In fact, I remember very clearly, I think it was 2014 or 15 at one of the broker conferences where Aditya Puri was speaking, and he said that, and when it was asked to him, who is your competitor that you respect? And he said, Bajaj Finance is my only competitor whom I respect. And he said openly, he said, I fired my consumer banking team that they were sleeping at the wheel. Suddenly this guy comes from nowhere and becomes so big because their go-to market strategy was very different, right? So again, you cannot, regulations can protect you for some time, but the march of technology will not protect you.
Next question, the change in consumer behavior after pandemic will stay forever, or will it go for after the pandemic, we'll go to the olden days? The consumer behavior, based on that, an investment thesis can be made, is what someone wants to know.
Well, I think that there are many aspects of the consumer behavior that will change, right? I did mention, for example, during the pandemic, you were locked down. You had no choice but to stay at home. You could not go to the shop, but the shop came to you, right? And then suddenly you realize that, you don't order only food online, but you can even order grocery. You can even order medicines, and everything can be delivered to you online. Now, does it mean that after all the restrictions are open, we will not go to the mall or we will not go to the store? No, we will go, right? Because you can't take away, humans want to interact with other humans. They want to touch, feel, etc. But if you were going for 100 things to the store, maybe you will now go only for 40 things, and 60 things you would order online. And that is going to change because you have suddenly realized the convenience factor. And the companies are pushing the envelope harder and harder, right? What is Instamart, which is part of Swiggy, doing? They are now saying that we are aiming to deliver grocery in 15 to 20 minutes flat. Now that's great, right? So maybe you do your weekly shopping by going to the bazaar. But let's say suddenly you run out of something in your refrigerator and you want it at that point in time. You are going to go online and shop, right? So I think consumer behavior has changed for good. The same is the case with how you consume your content on TV. I love to see some of the reality shows, but it is so painful because of the ads that come in between. I have now completely shifted to the apps, because you can fast forward the ad and you can just go to the part that you want to really see. You save time, you save the irritation. You don't have to sit for that 1 hour program. A 1 hour program can be seen in 30 minutes. That's 30 minutes of productive time that I've saved, which I can do something else, right? So I think consumer behavior is going to change forever. And I think even after everything is normal, now that we have learned remotely working, maybe we will go to the office. But let's say one fine day you figure out that, today I have all the work on once, I don't want to travel to the office. Does it mean that you will not be able to work 1 or 2 days from home? That's change in consumer behavior, right? And that will completely change, which means that you will need infrastructure at home. You will need connectivity at home. Your office applications and data will have to migrate both in the office, as well as it should be available in a secure manner at your home as well. So I think consumer behavior has this change was already happening. What COVID did was just completely accelerated the trend massively.
I'll go to the next question. In your recent video, you told technology is the new capex. As of now, it is very true. Do you think it will top out in coming days and it will take a backseat? You have quoted a lot of example from Tata Elxsi to other companies in your presentation also. What is your take on this technology? Will it be secular is what someone wants to know.
I think it is very clear that it is going to be secular. The reason why I say technology is the new capex, because that is true. Today, that doesn't mean that, if I need, in certain industries, you will need a plant to manufacture. There is no two questions about it, right? But I think even there, even in your production process, there is going to be change. And technology has already come in, right? And I was talking to the Bharat Forge guys a couple of months ago, and they said, look, when I set up my new plant now, I will probably have 1/4 the number of workers. And a lot of this is going to be automation and robotics, right? But what drives automation and robotics? It's technology, right? And I think, as I mentioned, that today, my spending is about how can I reach my customer online? How can I service my customer online? How can I communicate with my customer online? So where do I have to spend? I have to spend on my digital infrastructure. And that's the new capex. And that's why, when you hear, the heads of Infosys and TCS and all these guys, that they're saying that we are in a multi-year trend, right? Because they can see it. That's what their customers are asking them. It starts with simple. You move your data to the cloud, but once you move your data to the cloud, you need to move applications to the cloud. Then once you move it to the cloud, it needs to be secure, right? That nobody can hack into it. So you need to spend on cybersecurity. Then you want to be on social media, right? You want your products to be there on Instagram. You're not happy with just being on normal TV or in print. You have to spend. I think technology, capex is largely becoming technology driven.
Sir, already we are about 5 minutes ahead of schedule. Can I request you to stay for another 10 minutes to take a few more questions?
Sure.
Oh, good. Okay. Manufacturing is not a favored theme in India, as the capital markets in last 40 years has seen. Once China reverses the policy, will it adversely affect Indian manufacturing sector, on which a lot of big bets are put today?
See, I think I don't think China has a choice to reverse any of its policies, right? But even if they were to, let's take an example, even if they were to reverse their policies, what was their policy, right? So they were subsidizing their manufacturing industry. They were not taking care. They didn't really care about air pollution or water pollution. I think that as a society becomes prosperous, people want clean air. People want a quality of life, right? Otherwise, there will be a revolt. And therefore, I think that what China is doing today is to make, they had massive hyper growth, but that growth came at a certain cost, right? They created a huge debt bubble. Today, it has the highest debt to GDP in any developed country. They polluted their rivers. They had air pollution. I mean, you've heard that when there is Olympics, they ask all the industries to shut down because they want clean air. So I think that, first of all, my belief is that China cannot reverse from where it is. That's point number one. But even if they were to reverse, as I said, that because of geopolitics, one, and because of the experience post-COVID, I think that every buyer, every multinational has realized that they need to diversify their supply chain and not be dependent on only one country, right? I'll give you an example. You all know that, soft luggage that we use is all imported from China, right? Those bags that you carry, whether it's the VIP, aristocrat, whatever, right? Everything used to be made in China, including the zip used to be made in China. And then in 2013, when the taper tantrum happened, and if you remember, the rupee depreciated massively, right? Suddenly, VIP figured out that, you know what, I mean, my costs have just gone up by 30-40% because the rupee has depreciated and I have to import all of this stuff. And I can't suddenly increase the price of my bag by 30-40% overnight, because that will create a slump in demand. And then they decided to set up a plant in Bangladesh instead of China, right? They said, I cannot have, they still do import from China, but it's now become a very small proportion of what they do. And just think about it, as I said, right? If I am a pharma company, or if I'm a consumer product company, and if everything is coming from one country, and people realize that during COVID, you shut down the borders, right? And what is happening to the automotive industry? Suddenly, we never talked about semiconductor shortage until recently, but after COVID, we started, because there are only 4 large global semiconductor manufacturers which dominate. And today, look at what Tata Motors has said. They said, we are going to set up a semiconductor plant in India, because they realize that if I want to become a big dominant player in electric vehicles over the next 5-10 years, I cannot be hamstrung and dependent on some other country for a very critical input in my manufacturing. So I think manufacturing, whether China or no China, is likely to boom in this country, right? And I gave that one example of vaccines. Imagine if India could not produce its own vaccines. This country would have gone to the dogs.
Next question is on the retail participation, which has gone to dizzy heights. Usually the set of people think on a small noise in the room, people will rush to the door, and door is very small, and they cannot accommodate it, all who are exiting, and it'll be a cascade or a catastrophic outcome. Do you think the retail participation is matured in India to have a secular growth?
I think so. Look, there will always, see, I mean, there is no homogeneous investor, right? There are all kinds of investors. Somebody comes in for day trading, somebody comes in for a quick buck, somebody comes in as a long-term investor. I think, again, technology has played a big role, right? Again, in COVID, when people had nothing else to do, that started, they started investing in the stock market, started trading in the stock market. And that was possible because of many of these online broking platforms, which facilitated that. Again, technology facilitated it, right? And they could spend more time. But I think that this is a secular trend. And I definitely believe that, I think one thing great that the mutual fund industry did in India was to advertise mutual fund sahi hai and systematic investing, right? And I think that has kind of etched into people's minds. Today, also, a lot of information is available online. It's not that I'm the only person. So one is access to information. I think today, access to information and analysis is far better than, let's say, what it was 5-10 years ago. An average person can get a lot of information about a company online, right? Today, AGMs are held online. All results are available online. Transcripts of companies are available online. People who want to spend time can research sitting at home. So I think retail participation increasing is a secular trend in India. It's not like those old days that, gullible investors come to the market right at the top of the market. Then when the market crashes, they all run away. Yes, there will be a percentage of people who do not see the basic fundamentals of investing is something that you will have to follow. Whether you are doing offline broking or you're doing online, that's not going to matter, right? It's just a new channel which has opened up, which makes things easy. And I think that, we were always, one of the reasons why people were always bullish about the equity markets was that more and more domestic savings will come to the equity markets. And with interest rates being so low and, real rates being negative, I think that has pushed people to the equity markets. And I think with great regulation, with more transparency, with information available, my sense is that this trend is irreversible and it will only increase. Even if the markets were to correct from here, I think it will only increase.
I have two more questions. And the
Sure.
clean energy is emerging as a big theme. The biggest company in India has announced already a big capex. Do you think it is a long gestation to fructify this theme, or it will definitely come into your scheme of things in this particular fund you are floating?
Well, again, when it comes, so first of all, I think green energy is a reality, right? And I think I mentioned that ESG, environment, social governance, all of this is going to be important. And I think that's kind of forced Reliance to pivot so aggressively into green energy as compared to the oil and gas industry, because that's a dying industry, though it will continue to be relevant for many, many years to come. But I think last year, India added more power capacity in solar and wind than it did in thermal power, right? So I think green energy is here to stay. The good thing is that the gestation period for green energy projects is much shorter than the traditional thermal power plants, which used to take 24, 36 months to build, then a trial period, and then you would slowly ramp up your production there, right? So the cycle is definitely gotten shorter. Now, whether is it going to be profitable? I think that, in my view, time will tell, because right now we are in a very rapid, as technology is developing, as battery technologies, as solar technology is developing, the cost will keep falling down, right? So only people who have scale and efficiency will make money eventually in this business. But it's no different. I think ultimately it's a utility industry. So right now, I don't know. I mean, I haven't seen, existing green energy companies making great amount of profitability. But that could change in the future. Whether we will invest in the fund, I think we may invest in enablers in green energy rather than investing in green energy companies themselves. Though that's my view today, but that could change if I believe that the economics is changing and even green energy producers can be very profitable. See, my view has been that at the end of the day, energy is a utility. And in a country like India, you can't price utility very expensive. It is, and the regulators will always ensure that the producer doesn't make extraordinary profits, right? So that's not an industry that you would want to be, but you can certainly play this through other means. Enablers to green energy may be a better way to play.
This is my penultimate question. In your website, Mr. Rakesh Jhunjhunwala is found to be a director. Rakesh Jhunjhunwala, I'm extremely sorry. And how I can spell him, a big bull of India. Mr. Jhunjhunwala, what is he doing there, sir? And is he an active member? Can you throw some light on this?
Yeah, so, Rakesh ji has been a co-founder of Alchemy since day one, since Alchemy was formed. But he's a silent investor. He's not involved in the day-to-day running of the firm. He's not involved in the decision-making. He doesn't pick stocks. I think he does what he does with his own portfolio. That's independent. What we do is that we have an independent process. But yes, we have benefited significantly from his broad views on the market. We've learned a lot from him. So he's more of a mentor, friend, philosopher, guide. But he does not play an active role in managing funds or any role in the investment process. So I just want to make that very clear. So if you're giving money to Alchemy, it's not that Rakesh Jhunjhunwala is managing it, right? It's Hiren Ved and his team who's going to manage it. But yes, he's a founder, he's an investor, but he's more of a silent investor.
My profuse apologies for spelling him wrong, and I'm sorry. The last question is on the inflation and the central bank's behavior. I'm talking about risks to this market.
Yeah.
And what is your view? And in fact, taper and four rate hikes are scheduled to be scheduled to happen in the US, and even central banks in India is going to raise rates for sure in coming months to tame the inflation. And what is your outlook and how it is going to affect the equity market, the central bank's behaviors?
So, I think it's an interesting question. And I'll be honest, I don't have all the answers, right? Because we are in truly uncharted territory. We know with a little bit of experience post the global financial crisis, that was the first time when central banks, started to expand their balance sheets and started to stimulate and cut interest rates to virtually zero, right? My sense is that the reason why global markets are behaving the way they are behaving is that they are pricing in a higher cost of capital, right? So I think it is a foregone conclusion in my mind that interest rates are headed higher, both globally and in India. There is no doubt about that. But that doesn't mean, if you look at historically in the past, there were two instances in the past. One was between 2004 to 2006, when US interest rates were increased by almost 430 basis points. But during that period, when interest rates were continuously hiked, right, equity markets gave a positive return. Both emerging markets, global equity markets, Indian equity markets were up during that period. The second recent instance is when the Fed raised rates by almost 200 plus basis points between 2016, I think October 16 to Jan 2018. And even during that period, interest rates went up. And I think that, one is cost of capital, but the other part of the equation is that which is very important is earnings. If earnings continue to grow, right, then markets will reflect earnings growth. But the discount rate that you use to discount the cash flows is definitely likely to go up. So companies where the profitability is too much into the distant future, those companies will have a significant knock on their valuations than companies which are currently profitable, right? So there will be an adjustment in the PE or the valuation, right? Because interest rates and PE are inversely correlated. Lower interest rates means higher P's, higher interest rates means lower P's. But it's not a very simple equation as that. We try to simplify it like that. The other element is growth. So if earnings grow and if the sustainability or the runway of earnings is going to be fine, then I think you'll be fine. So I think, this big scare that people have that the, markets are going to crash and burn. Well, markets can correct. I don't deny that. And I think we should, all investors should be cognizant of that risk. But it's not the end of the world. I think we've seen several cycles in the past where inflation has gone up, interest rates have gone up, and despite that, markets have delivered positive returns. But then don't tell me that, 6 months markets was down. I mean, that's quite possible. You got to take a slightly longer term view. And I think money will be made.
In fact, when a tall fund manager like you coming for a webinar, lot more questions have come, and punity of time will not be able to take all those. We will send it across to you, and
Sure.
your team can answer for all unanswered questions. I would like to thank you for an enriching presentation by you. I would like to thank all the participants and wishing them a very happy new year. Thank you very much. Thank you, sir.
Thank you. Thank you, PMS Bazaar, and thanks to all the participants.